Hello and welcome to the Currency Exchange, NatWest FX podcast, where we break down the major themes and events driving currency markets this week and in the week ahead. Today I'm joined by Brian Daingerfield, who's our US head of G10 FX strategy. Brian, we spoke last week on anticipation of Trump coming to power. Events have unfolded. He has come into the office, and I think the statistic is he signed the most executive orders of any US president in his first day. So now that Trump is actually in position, what do you make of all these executive orders that have been passed?
Well, thanks very much for having me, Eimear. So, we talked about this on last week's episode for those that listen. We talked about how we thought the most important, for markets, the most important executive orders would be what we did and did not get on tariffs and trade. And I think with hindsight now, having seen, as you mentioned, a record-breaking number of executive orders, that has indeed been the case, with greater focus on what we really didn't get rather than what we necessarily did. So just marking ourselves to market and my own expectations to market, as we discussed on the pod last week, Eimear, was my own expectation was that Trump would not announce any specific tariffs in his initial executive order slew. That was correct in hindsight. But what I did expect that he did not do was he did not declare a national economic emergency. My own expectation was that he would go a step further, declare a national economic emergency, which would give him the authority to snap tariffs into place extremely quickly. I thought that could be a day one possibility, but that we didn't get that either. We got somewhere in between those two, where Trump basically put everything on the table as far as trade, but didn't follow through with any specific one. So he didn't rule out declaring a national economic emergency to very quickly flex tariffs into place. But the executive order that he did put out kept open that possibility. It specifically cited the piece of the U.S. Code, which includes that language. He also tasked various different authorities within the U.S. government to research and look into the ability or the willingness, the need to use some of the more methodical trade options available to him. Those who are familiar with the first term trade war, things like Section 232, Section 301, Section 201. These are all different trade war authorities that Congress has given the president in previous laws. Almost all of them were cited in the initial executive order. And so what we got from the president was no initial move on tariffs, but keeping all options open, not going as far on the emergency declaration that I thought, but still keeping all of these options open. And to that point, we have heard from Trump a couple of times now, the possibility of tariffs being snapped into place as soon as February 1st. And so it's not to say that these risks are now to the side here, but he did not move on his first day, and clearly that's moved markets.
And where do you think those risks for tariff, which countries are those risks the most acute?
So to me, it still feels like China is probably the country where the risks are, as you put it, the most acute. Certainly in the immediate term, Trump's focus has been on Canada and Mexico, specifically this 25% tariff on all imports from Canada and Mexico that he sort of casually mentioned this week could come as soon as February 1st. Now, personal expectation here is that February 1st could be a date that sets up another date. Maybe that's not the day that tariffs come into effect, but perhaps that's a date when, if we don't get a meaningful breakthrough in terms of Trump being satisfied with changes in policy that we've seen in both Mexico and Canada related to border security, that could be a moment where Trump sets another countdown in terms of tariffs. So, for example, that's a moment where we get an executive order that says, under the IEPA, I will change the tariffs on a certain date, like within 30 days or something like that, unless we get movement, right? And so these risks, I don't think, have gone away in any meaningful way. The sword of Damocles of tariffs still hangs over these economies. I think that's right to say. But I think it's pretty clear that the market is still trying to find its equilibrium, with there being two clear camps in terms of expectations. One camp that thinks that Trump is unencumbered in his second term and wants to move more aggressively on tariffs and is willing to move more aggressively and is not going to be swayed by more moderate voices in his camp. There's another side, and I think it's a larger camp, that thinks that Trump is so market sensitive, that he's so sensitive to the potential for inflation risks and the potentials for markets to become unsettled, equity markets to decline if Trump were to follow through on his most aggressive trade push, that he's unlikely to follow through on the most aggressive moves. And certainly that latter camp has a bit of a pep in its step over the last couple of days because Trump didn't make his move. And now we're recording on Thursday. The president is actually speaking live to the World Economic Forum in Davos as we are recording. So, we're going to get a very near-term update coming soon. But look, that we're only a few days in, and the market is clearly seeing, I think there's some extrapolation of this lack of immediate term move as maybe as a sign of what's to come, that maybe the push will not be as large, will not be as fast. It's probably too early to make that decision definitively, though I do think that the consensus probably leans in that direction, that Trump is more market sensitive. And so what we have seen is that in combination with some softer CPI, U.S. inflation numbers in the U.S. that we saw last week, that's helped the dollar consolidate a little bit here, has slipped a little bit after a very, very strong couple of months period in the transition time.
Yeah, I'm interested, to know what you're looking at next for the dollar. We've obviously seen it come off, that 13th of January high. For you, is Trump policy in the driving seat from here, or is it that economic data or driver of both?
I think it's a mix of both. Now, of course, if we do get a snap tariff increase on February 1st, as Trump has, as alluded to a couple of times, then suddenly that could certainly take precedence over the immediate term economic data, especially for the affected countries, right? You're talking about Canadian dollar, Mexican peso, Chinese yuan as well. We've seen adjustment in these currencies in anticipation of trying to handicap that risk. Very difficult to get a sense of whether or not those risks are fully in the price or not, simply because, as I mentioned, the consensus is divided on whether Trump's threats are serious or whether or not we're more likely to see a decline or a less aggressive push. But we should also consider the data that's going on, in the background here, that all through the Trump transition period, we've seen economic data that have generally been stronger, especially on the activity side. The non-farm payroll earlier this month, for example, retail sales was solid. The inflation numbers, as mentioned, those were a bit softer than expected, and that is good news. The CPI coming in weaker, likely leading to a lower core PCE deflator as well, the Fed's preferred measure of inflation. But what we're worried about is that as you head into the beginning of February and you start to get get back into the teeth of the big U.S. data cycle, when we get the non-farm payroll on the first Friday, and then we get the CPI later in the month, I think what markets will be looking forward to and what we should be watching is that turn of the year data we've seen, especially in inflation, signs of seasonal, maybe residual seasonality, that some of those inflation data at the beginning of the year have tended to be stronger than inflation at the end of the prior year. We've seen that seasonal trend a couple of times now in the post-COVID era. And so we think that investors should be mindful of that possibility that we see a snapback higher in U.S. CPI. And so while we are watching and are certainly very attentive to what we're going to hear from Trump or maybe won't hear from Trump, the market seems to be a little bit more confident that the ultimate trade push is going to be less severe than was promised on the campaign trail. At least the first couple of days maybe leans in that direction. So we'll be watching whether or not those expectations, which seem to be gathering a little more steam recently, are those validated or are they pushed back on by what we hear from Trump over the next week? But then also for the dollar, we're of course watching this data. And if we do get some of that positive seasonal factor, we're looking at a potential for a 0.3% or even maybe rounding up to a 0.4% on the core CPI when we get that number in mid-February, for example. And so that's something that could act as a bit of a limit in terms of how much further the dollar has to consolidate or decline from here. So, Eimear, let me turn to you now and ask you about emerging markets because, a lot of emerging market currencies are really, within Trump's, purview in terms of specific tariffs, but also, in terms of indirect impacts. Certainly a lot of currencies in your space are certainly impacted by what's going on between Trump and the Eurozone, but also with China as well. What has been some of the reactions in emerging market currencies, and what are the themes that you're looking for here as we assess FX markets in the new world?
Yeah, I would say to sum it up in a word, it's relief. There's definitely been a bit of a relief rally coming through in emerging markets. I think the emerging market currency space had a lot of time to kind of price in what would Trump's policy be. So, the prospect of a universal trade tariff, the prospect of 60% trade tariffs on China, the outlook that there could be less Fed easing. These were all massive headwinds for emerging markets, and we really saw them kind of preemptively price in a Trump 2.0. So for example, in the case of South Africa, it declined, past 19 against the dollar, so historically very cheap levels. It was actually enough to offset, a 3.5% US tariff applied indiscriminately across all of South Africa's exports to the US, and for half at 7.7 or 7.5% tariff on all its US exports. So it really saw them, act preemptively. And as you said, we just didn't get that trade policy front and center. So I think there is a relief that, maybe perhaps the new administration, their focus isn't on kind of redressing global imbalances when it comes to trade. And any tariffs they have suggested are in reaction to kind of national security concerns. So for now, it doesn't look like the world's largest export market is in danger. We do have now a number of currencies that are trading at, very cheap valuations, and they're backed by strong domestic fundamentals. So if you take away that threat of a global trade war, of trade barriers being erected, of less easing from the Federal Reserve, there's a lot of opportunity within EM for particularly, we've been very bullish on the Polish zloty. Europol just broke through a key support level of 4.25 yesterday, and it's seen significant downside momentum, and we think there's further to go. We're still very bullish on South African rand, which offers investors a lot of carry and has really strong fundamentals, and also the Brazilian real, where its central bank has embarked on an aggressive hiking cycle, again offering traders a lot of carry and at relatively cheap valuations as well. Well, Brian, thank you so much for joining me. I've loved our rundown of Trump 2.0 so far, but I will let you get back to hearing Trump's speech in Davos. Thank you so much for joining me. That is all we have time for in today's episode, but do click like and remember to subscribe so you get the latest episode first. Thanks again.